This is the class for CFA level 3, and today we are going to discuss the asset allocation. Asset allocation is a very important topic in terms of CFA level 3 examination and in terms of a practical CFA workings, and it requires a lot of practical knowledge when you work in the real organizations. We'll keep in mind the practicality and the theoretical concepts together in our discussion. I will start with our discussion with asset allocation, and asset allocation should always be strategic. When we say strategic means that it should have a long-term vision, because certain assets may have a life of 50 years, 40 years, 30 years, so there should be always a long-term vision in our mind. This is the first thing. Second thing is, in terms of capital markets, we have to see that the long-term capital market expectations to choose the long-term target allocations. What is the capital market expectation? And this is involved for an appropriate client IPS. We have to see. We have to assign different weights. So weight should reflect the investor desired exposure to a risk, ideally a systematic risk. How much a client want to diversify, and what is the portfolio perspective. This is we have to keep in consideration. In terms of tactical asset allocation, first of all, we should have tactical management skills, which is handling the short-term, long-term, and medium-term situations. So temporary deviations from strategic allocation, this is based on short-term capital market expectations. So we'll see what is the market expectation in short-term, was develop a tactical strategy accordingly. Then sometimes we face mispriced securities and sectors. Sometimes interest rate expectations are volatile, and sometimes, even most of the time, currency is also moving up and down. So currency expectation will be a vital factor into. In terms of value of strategic allocation, we should be provided with a proper discipline. In terms of returns are determined largely keeping in view the strategic allocations. And there are so many studies available, especially the empirical studies, which is based on observation. Facts and figures, result really matters, and sometimes returns to the tactical allocations are minimal at the best, and at worst insufficient to cover the associated operating expenses and trading cost. So in that particular scenario, so what should be the possible way of actions? In terms of the asset allocation, we always have two options. One is asset liability option, one is asset only option. This is like, if you see logically, if an entity is having assets, these assets are either backed by their own equity or liability. So what will be the right combination? This depends upon the circumstances and situation of a particular investment option. An asset liability approach to a strategic allocation chooses assets to satisfy pro-specified liabilities and maximize the surpluses. An asset-only approach does not model liability at all. It's only focused on the assets, focusing on earnings, the highest return of a given amount of risk of not funding liability is not specifically addressed and controlled in this option. Dynamic versus static approaches. We have in terms of investments, asset allocation. Dynamic approaches recognize that the risk and return in one period affect the performance of the others. So one quarter effect can be carried forward to the other quarter results. This is based on the ideology of dynamic asset allocations. In terms of static is having no movement, no linkage, so they believe that there is no relation. They ignore the links between the time factors and the later periods with the preceding periods. Dynamic allocation is really difficult, and it may be costly because of its dynamic adaptability and linkage of certain factors. Investor, they are using an asset liability approach. They prefer dynamic allocation because it seems more comprehensive, especially when the timings and amount of liabilities are uncertain. So it's give a quick review, relationing, and it adds value in terms of asset allocation techniques. Asset allocation has different standard and predefined behavioral characteristics. While we do asset allocation, there are typical ways to do. First of all, we can try to averse, like we can be a loss averser. Loss aversirs, like individual display, become risk seekers when faced with a high probability of a risk. We have already discussed that when you have a sudden loss, so sudden recovery of this loss is through a high risk security. This is a logical relation between both. There is a couple of mental accounting involved into. Individual place their assets into separate buckets, and each with a different purpose, different portfolio. So different baskets have different risk and different returns. Fear of regrets of making poor decision is always goes side by side. When we win, we feel it was our decision and we were rational, we did this. But once we lose, we face self-criticism. We feel, okay, if we could do this way, we can do that way. But this is again associated with this investment field, that we may have a fear of regret for making a poor decision. That can only be settled through diversification, and we can limit diversification from peers asset allocation of a peer comparison. There could be certain techniques to restrict yourself from saving too much diversification in general. Risk and return objectives is really required to define when you are going to have the relation of risk and return with asset allocation, because assets, first of all, you should know what is the expected risk return specific to the asset allocation. Then we will make a portfolio according to the most suitable, efficient with risk and returns. So the return objective of an individual institution's portfolio is based on the size of portfolio, their long-term spendings like liquidity needs, time horizons. Sometimes you have too much liquidity, so you are looking for that kind of investments which does not give you a prompt cash flow. You are not looking, in fact, immediate cash from these investments or allocations. You will be choosing those portfolios which is long-term and more rewarding, rather to go for a short-term liquidity based financial asset, and you will do allocations based on that needs. So how we decide, of course, is the individual circumstances, needs, allocations, or expected risk returns. Portfolio returns must cover spending needs, expected inflations, management fee. This will tell them the real profitability out of the asset and efficient asset allocations. Inflation is something which we already discussed in economics. Inflation is really important to consider. We can link it with time value of money as well, because maybe dollar today was like $1 today is worth, maybe after 10 years, 20 years, what will be the intrinsic and real value of a dollar. We have to consider is as today. If a return is increasing but the things are persistently increasing in the general market, so the real gains are squeezing. These all things we have to keep in considerations when we are going to design some portfolio. In terms of risk, the risk objective should be specified. Investor should know that he is a risk averse, risk seeker, or risk neutral. But in general, like risk investor can have a score based on their tolerance, risk appetite, or aversion to risk. Below average risk tolerance, maybe high risk aversion, score 7 to 10. Above average risk tolerance, low risk aversion, will be scoring 1 to 3. So this way we can manage the efficient allocation. Investor may use utility adjustment return formulas. That is like the variance of portfolio, investor risk aversion scores, and expected return on portfolio can be matched, and it can give you the right solution in terms of quantitative terms. In terms of, there could be two implications of this risk objectives. If two assets has the same risk and the return, so obviously they are positive correlated, the choice is driven by the investor risk aversion. So this is his own decision. As risk aversion increase, the deduction for risk also increases. This is like we can say that it is with the high risk aversion score, it will be a deduction of the risk increase. We will observe it neutral this way. Sometimes we have downside measures of risk like shortfall risk, then we have semi-variable